very active in the public finance sector. In 2020, we closed 843 bond issues totaling just under $19 billion. So it's a very important part of our business.
Welcome to Buzz House, a Baker Tilly podcast where you can find all the buzz around multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Garrett Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Each week, we'll bring you a guest or a topic in the multifamily housing industry that will help you win now and anticipate tomorrow. Let's get started. Today, our guest in the Buzz House is our good friend, Cody Wilson, who is a managing director of public finance investment banking with the firm Piper Sandler. We'll be talking today with Cody about what he is seeing in the tax-exempt market for affordable deals and trends that we should all be aware of, especially now that projects can take advantage of the fixed 4% credit rate. So I think we'll have a lot of discussion around that. And I'm sure all of you are looking at probably a lot of 4% deals right now. Before having a discussion with Cody, just a few quick updates from around the industry. To start out, the Centers for Disease Control and Prevention, or the CDC, did issue an order extending the federal moratorium on evictions for non-payment of rent through March 31st, following the directive issued by President Biden on his first day of office. The eviction moratorium had previously slated to expire on January 31st, will hopefully keep millions of renters housed during the pandemic. Of course, the back amount of rent due is growing. In many cases, we've seen utilities not being paid here during the winter. So although helpful, still not kind of that silver answer to the issue. So I think the whole industry will be continuing to monitor that as well. Switching gears, we've here in the Buzz House have been talking a lot about the fixed 4% tax credit percentage. Since it has passed, there's been a lot of discussion around the impact of this change of those projects that have issued their bonds prior to January 1st, 2021, and those projects that have not. This legislation, of course, permits a minimum 4% credit rate for qualifying housing projects which meet certain criteria that is outlined in the Act. The California Tax Credit Allocation Committee, who often takes early positions in the industry, but again, not necessarily the letter of the law, has come out with their positions. Their take is that for 4% projects that issued any bonds prior to January 1st, 2021, unless there is further guidance from the IRS or the Treasury, that those projects would not be eligible for the 4% credit rate. We'll kind of, that's again, it's a lot of discussion with bond attorneys and so forth that we'll keep you up to date. Again, California often takes early positions, but again, not the letter of the law. So we'll continue to monitor that and have those discussions and report back to you as we go through that. Finally, we've had a lot of discussion recently as well on income averaging. Recently learned that the IRS will hold a public hearing on March 24th. There, of course, were numerous industry comments to the proposed regulations which came out in the fall. One major concern, of course, is the inability to modify income designations once made by the owner. Those who would like to testify at the hearing, which will be held virtually, must submit their contact information and outline of their expected oral comments by March 5th. Note that, and if you're working on an income averaging deal right now, you may have seen this yourself, that a significant slowdown in investor appetite pending the outcome of these final regulations. So a lot of the industry is on the sidelines waiting for income average deals. Now excited that Garrick and I will be able to jump into our discussion with Cody Wilson of Piper Sandler. Garrick?
Hey, thanks, Don. And hey, Cody, thanks for being on Buzz House. Why don't you go ahead and tell our listeners a little bit about Piper Sandler and what you do there?
Sure. Thank you. Good to join you guys. The Piper Sandler and Company comes from a merger between Piper Jaffray and Sandler O'Neill and Partners. The firm was founded in 1895 and is based in Minneapolis. We have a very diverse business mix consisting of investment banking, equity sales and trading, public finance, fixed income sales and trading, and private equity strategies. We're very active in the public finance sector. 2020, we closed 843 bond issues totaling just under $19 billion. So it's a very important part of our business. I lead the Affordable Housing Investment Banking Group. Our role is we originate debt financing for affordable housing developments. Our clients include for-profit developers, nonprofit organizations, state and local housing agencies, and tax credit consultants such as Baker Tilly. You typically see us serve as bond underwriters on 4% transactions. However, we do arrange debt financing for other types of transactions, including nonprofit bond issues, construction financing, workforce housing, senior housing, including independent living, assisted living and memory care, and we also finance on-campus and off-campus student housing projects.
Wow, that's a lot. Did I hear that right? Did you say $19 billion? Was that 1 year?
Yeah, that was our public finance group, which we, do housing, government issues, infrastructure, all fits in the tax-exempt space. But yeah, close to just under 19 billion last year. So obviously, it's a very, very important part of our firm's business.
That's amazing. On Buzzhouse, we've actually been having a lot of discussions on the new 4% lock on LIHTC projects and the different types of structures that go into that, including the private placement bond execution. So how does that market look right now?
Well, the private placement market comes and goes. Right now, you have some banks who are very active in this space. Your more traditional private placement firms are on the sideline right now. Most of those guys run securitization programs, and they typically need around a 4% rate or higher to make those numbers work. Obviously, with the 10-year Treasury around 115 right now, it's very hard to charge a developer a 4% rate and think you'll win the deal. So most of the private placements we see are just with banks right now. You may see a couple other type private placements show up in kind of rural areas or areas that are not very heavily populated. I mean, obviously, the 4% fixed tax credit rate will increase tax credit transactions. As you guys know, a lot of deals that didn't work now do work. So we are starting to see a lot of states run out of volume cap. Texas, Tennessee, Georgia are some states that come to mind.
Yeah, thanks for that. It seems like the 4% lock, I would think that would increase that activity, but I guess it's interesting your take on the 4% rate and I've typically seen around there on private placement bond transactions, and given how low rates and other products, interesting to see where they'll go from here. So Cody, we've also talked through, a few 80-20 type deals where the city's requiring, some affordable units as part of zoning or a requirement to receive any tax increment financing or other local type incentives. So what does your tax exempt bond product look like around this sort of 80-20 scenario?
Yeah, so we've been really seeing this, and this execution kind of pertains, you can do it as a 501c3, but we've been looking at it for for-profit developers, and, obviously they'll be issuing Section 142D bonds. We do have some institutional investors who would take the construction and lease-up risk. These bonds are sold either through a limited offering or a private placement. Remember, there are a couple key points your developers would need to think through. Since this is a 142D bond, you would still have the income set-asides, your 20 at 50 or 40 at 60. And recall, this is an income test only. There's no rent restrictions. Unfortunately, you still must get volume cap. So those states that are short on volume cap, this may be an issue, but there are plenty of other states out there who have plenty of volume cap, so that may not be an issue.
Speaking of volume cap, so, if you are in a state with volume cap, are you seeing any other type of structures that could be implemented to where they can still be treated as like true government bonds and not have to go against the volume cap and still team up and have some sort of economics that can happen to a developer in that scenario?
That's a great question. And yes, so we've seen a couple deals in California recently where there's an issuer in California who has essentially set up a subsidiary that is essentially the borrower of the project. And they would issue the bond, so it's really considered a governmental bond issue. So you don't have the volume cap issue. In that particular issue, the developer would still serve as the developer. They call them a program administrator on those deals, and they still would do their development functions. However, the drawback there is the developer doesn't own the project. So any upside down the road, if they want to sell the project, unfortunately, they would be, cut out of that. They simply just serve as a fee developer, get a fee at closing, and some of these guys stay on and serve as an asset manager. So we've seen that in California, which I think there's probably been, 5 or 6 deals done that way. There is some affordability component there, but those really are geared toward acquisition rehab of existing housing that's really transformed into workforce housing. By doing it under the Section 142D, your for-profit developer, they can stay in the deal, they own the deal, and down the road, if they ever want to sell the deal, they get that upside benefit.
Interesting. Thanks for that.
Yeah.
I think Don has a couple of questions as well.
Yeah, Cody, actually, one real quick question, just on, as far as terms, are most of the placements, getting 40-year amortizations, or some still at 35? What are you seeing on amortization?
Yeah, most of them are 40-year AM. 40-year amortizations, the term varies. You can do a long term. Most of the stuff we've been seeing has been, 10, 15 years. And the great thing about the bond execution is we do offer a shorter, more flexibility to call the bonds earlier. So we do offer, liquidity where if you do want to sell the property or project in, 7 years down the road, you do have that flexibility to call the bonds in and do that. But nevertheless, we kind of, lock you in at the long rate, but still give you flexibility to call the bonds and refinance if you so choose. And coverage, Don, is, usually, 115.
Sure. Perfect. No, very good. What do you know, we always get the questions, properties come up to year 15. Obviously, the first mortgage is coming due. What are some, if I'm either, looking to acquire an asset or year 15 asset or refinance an asset, or some of these tax-exempt products, or what are some of you and your clients looking at with, kind of year 15 acquisitions, refinances? Are they the same products or different products?
Yeah, I mean, a lot of the guys we talk to, they have some bridge mechanism that maybe if the property's not quite year 15, they'll take down. Something we've been using, we have some 501c3 clients, and we also have some developers who have, friendly nonprofit organizations where essentially we just go and do just a bond deal, 501c3 bond deal, and that could be done as a limited offering or private placement. And again, we're basically giving the client, a 10 to 15 year rate, do a 40-year AM, but we're giving them the short call option. So if they're ready to do a credit deal in 3 to 5 years, you would call the bonds in. I kind of refer this to as a leverage bridge loan because, our clients will do, 100% leverage. So we've been seeing that a lot lately and have done that. But, I think, and then again, we have a lot of C3 clients, Don, who buy these year 15 properties and, they're buying whole strategy. They buy the property at the right price. They're able to do enough rehab and, they put long-term financing on the property. Maybe there's a tax abatement play, and they just keep the property for a long time and use that cash flow to further their charitable mission.
Yeah, it's really, really powerful products. So thanks for sharing that.
Sure.
I've got one last question, Cody. I know we talk. It seems like there's always the next product or what you're thinking about. Are there anything you and Piper Sandler are thinking about, or what's new? Or I mean, obviously these products we're talking about are obviously very effective right now. Is there anything next or other products our listeners should know about?
Yeah, so we talk frequently, Don, and we're always trying to come up with new ideas, either through new products or new ways of structuring deals. And we are working on a few exciting things that we hope to roll out here in the coming months. I don't want to give too much away, but it does involve a couple new ways to finance some tax credit deals, both new construction and ag rehab. So we're excited about that. And I think as far as trends go, our clients are really, it seems like more developers are pursuing the workforce housing developments.
Yes.
And most of those are either through new construction or, acquisition rehab. I know Fannie's got a workforce housing product, as does Freddie Mac. But then you can also, we're working on a few deals, structuring how you can do just a straight bond deal. Like those deals that were done in California, we're working on a few other deals in different states right now using just tax-exempt bonds. So I think a lot of people are really focused on that and figuring out the best way to do those deals. So I think you'll see more and more workforce housing deals done this year. And then obviously, I think you'll continue to see a lot of pressure on volume cap. Like I said, a lot of states are just pressured right now. And, then you start thinking about, will we see some type of legislation down the road that reduces the 50% test? So, that's certainly something to keep your eye on as well.
Well, that sounds good and encouraging. And Cody, we're probably gonna have to bring you back once we find out what those.
Yeah, new you have to have me back. We'll love to give everyone an update.
That sounds good. No, thank you very much, Cody, and listeners.
Well, thank you.
Yeah, Cody Wilson
You,
from Piper Sandler joining the Buzz House, and listeners, thank you for tuning in today. Thank you for listening to Buzz House. To receive a notification when new episodes are available, please subscribe to Buzz House, a Baker Tilly podcast, wherever you get your podcasts. For additional resources around multifamily housing, check out bakertilly.com. And if you have a suggested topic, please send them to build@bakertilly.com. That's BUILD@bakertilly.com.